You know that feeling when you're about to check out online? You type in your address, and suddenly the price just jumps? Yeah, you're not alone. Today, we're going to try and unravel one of America's biggest, most common headaches: why U.S. sales tax is so unbelievably complicated.
I mean, think about it. You might buy a laptop and the tax is, say, 6%, but your friend who lives just one town over pays 8%. Or you're shopping online and that final price is a complete mystery until the very last second. It feels totally random, right? But believe me, there is a very, very complex system hiding behind all that madness. And it all starts with one pretty staggering number.
Here's the reason for all the chaos: 12,000. And no, that is not a typo. In the United States, there are over 12,000 different sales tax jurisdictions. You've got states, counties, cities, even special little districts for things like stadiums or public transport. And every single one can have its own rules and its own rates. That right there is the root of all this complexity.
So that brings us right into our first section. This whole system, it's not a bug, it's a feature. It's a fundamental part of how the US is set up, and it creates what you can only really describe as a confusing tax patchwork.
Okay, so at its very core, sales tax is actually a pretty simple idea. It's what's known as a pass-through tax. The store you buy from collects the tax from you, the customer, and then they just pass it through to the government. And that money, that's the lifeblood for all the public services we rely on. We're talking roads, schools, fire departments. So you can see why states are so invested in making sure they get every last penny.
All right, now here's where we see the first real layer of complexity. States can't even agree on where a sale actually takes place for tax purposes. A few states are origin-based, which means a tax rate is set by where the seller is located. But most states are destination-based, and in that case, the tax is calculated based on your ship-to address. This is exactly why your online shopping cart total can magically change the second you type in where you live.
And oh, it gets even messier with this thing called tax pyramiding. Just imagine a local pizzeria. Okay, so the state puts a sales tax on the flour the baker buys to make the dough. That tax cost, it gets baked literally right into the price of the pizza. Then, when you come along and buy that pizza, you get charged sales tax on the entire price, which includes that hidden tax on the flour. So you're basically being taxed on a tax. As you can imagine, most economists agree this is super inefficient and it just distorts the market.
You know, this messy patchwork system, it worked kind of in a world of physical brick-and-mortar stores. But then the internet happened. And that brings us to our next section, the Great E-commerce Tax Showdown. For the longest time, the rule of the road was simple. It was all based on a 1992 Supreme Court case called Quill. And the rule was this: a state could only force a business to collect its sales tax if that business had a physical presence, a store, an office, a warehouse, something tangible inside that state's borders. This was the law of the land for mail-order catalogs and, for a while, the early days of e-commerce.
But as online shopping just exploded, that old rules started to look, well, ancient. By 2015, Supreme Court Justice Anthony Kennedy was practically sending up smoke signals that the court was ready to revisit that Quill decision. And the state of South Dakota basically said, challenge accepted. They passed a law that was specifically designed to get a brand new case in front of the Supreme Court. And in 2018, their big gamble paid off. The court agreed to hear South Dakota v. Wayfair, and that set the stage for a seismic shift.
And the outcome of that case, well, it changed everything. It ushered all of us into what people now call the Wayfair world. So let's take a look at what this new reality actually means.
So the Supreme Court didn't just tweak the old rule, they threw it out completely. It was replaced with a totally new standard called economic nexus. And this is the key takeaway. A business no longer needs a physical store in your state to have to collect sales tax. Now just having a significant economic connection is enough. And that's usually defined as making over $100,000 in sales or having 200 separate transactions in a state within a year.
And this quote right here, it just brilliantly illustrates the court's reasoning. Writing for the majority, Justice Kennedy said that the internet had fundamentally changed our economy. That old physical presence rule was from a totally different time. The court was recognizing that e-commerce wasn't just mail order 2.0, it was a completely different animal, and the law desperately needed to catch up.
So why did states fight so hard for this change? Well, it all comes down to money. A lot of it. Back in 2017, a government report estimated that states were losing out on as much as $13.7 billion in uncollected sales tax every single year. That is a massive chunk of funding for schools and roads and public safety that was basically just vanishing into the digital ether.
Okay, so now pretty much every state with a sales tax has some kind of economic nexus law on the books. But
what about those states that don't have a sales tax at all? Well, this leads us to the really fascinating myth of the tax-free state.
Yep, it's true. 5 states have no statewide sales tax: Alaska, Delaware, Montana, New Hampshire, and Oregon. On the surface, that sounds like a shopper's paradise, right? But that label, tax-free, well, it can be a little misleading.
Because, let's be real, there is always a catch. States have to get their money from somewhere. So instead of a statewide sales tax, they just get creative. In Alaska, local towns can add their own sales taxes. Montana has special resort taxes in popular tourist spots. Delaware brings in a fortune from all the fees companies pay to be registered there. And Oregon has a tax on a business's total revenue. As for New Hampshire, well, they've got their own solution.
Let's just use New Hampshire as a perfect case study. It's famous for having no sales tax and no income tax. Sounds great, but look at this chart. To make up for it, the state has some of the absolute highest property taxes in the entire country. You combine that with business taxes, and that's the vast majority of the state's revenue. So tax-free doesn't really mean low tax. It just means the tax burden is shifted somewhere else.
All of this complexity, the 12,000 jurisdictions, the patchwork of rules, the weird exceptions, it just begs one huge question. Why doesn't the US just simplify things and create a single national sales tax like most of the rest of the world does?
See, the global standard is something called a value-added tax, or a VAT. Over 170 countries use it. And unlike a sales tax, which is only collected once at the very end of the line, a VAT is a consumption tax that's collected in little pieces at every single step of the supply chain, from the person who provides the raw materials, to the manufacturer, to the wholesaler, and finally to the retailer.
In this slide really just lays it all out, plain and simple. You can see the US system is this tangled, one-time collection right at the very end. A VAT, on the other hand, is a much cleaner, step-by-step process, and for governments, it creates a much more stable and predictable stream of revenue. So why is the US the big exception? It really comes down to a fundamental choice that was made a long, long time ago, to prioritize the power of individual states over national simplicity. And that plays out in 3 ways. First, federalism. States fiercely protect their constitutional power to set their own tax laws. Second, the sheer complexity of trying to get those 12,000-plus jurisdictions on the same page would be an absolutely massive undertaking. And finally, there's just not the political will. Creating a brand new national tax is one of the hardest things to do in American politics.
Which brings us to the big, final, unanswered question. The Wayfair decision absolutely dragged our tax system into the internet age, but it didn't simplify it. In fact, for a lot of online businesses, it made things even more complicated. So, as our economy becomes more and more digital, more borderless, is a tax system built on physical state lines and thousands of local rules really built to last? That is the billion-dollar question that businesses and lawmakers are still grappling with today. Thanks for joining us.